Time now for our Wall Street Week Daily segment. The host of Wall Street Week, David Westin, joins us. David, your show kicking off at 6 p.m. Eastern time here. And I know you had a sit down here with a really key person here in the private credit space. And we know this has really kind of been the dominant conversation really for the last couple of years.
Yeah, in particular as we look toward further rate hikes. And somebody you know well, you talked to her just last May, actually, Purnima Puri. She actually is HPS Investment Partners. And we talked to her, given that we saw the jobs numbers today and what might be coming from the Fed later this month, what that may mean for credit, where credit is and where it's headed.
We generally deal with levered credit. And I think that we are of the view that there are likely to be one more hike. Maybe there's two more hikes. I think that in general, we're sort of closer to the end of Fed hikes than obviously we are to the beginning. So I think we're coming to the tail end of the hike cycle. And people are starting to now look at 24 and, you know, when is the Fed going to cut and what are the indicators they're looking at that would make them cut?
So when I checked it this morning on the Bloomberg, the spread for high yield, just to take high yield, was something like above 450 basis points. Where do you expect that to be going? Is that where we end up, or is that going to continue to rise, and if so, when?
Yeah, so I think you got a big push and pull, which is that base rates are pretty high, north of 5%, and then you've got spreads that are actually not that wide, and perhaps not representative of the risk in the corporate credit market. And I would actually say that's true for investment grade as well. I think investment grade is, 140 over plus or minus, and high yields in the sort of low to mid 400s over. So I think our view is credit spreads are not indicative of risk necessarily. Yields all in are reasonably wide. So that's the trick. And I would suspect that you'll see spreads go a little wider, primarily because we do think you're going to continue to see some margin deterioration for levered credit, number one. And number two, we do think we're in a bit of a longer, sort of higher for longer rate environment, which will pressure cash flows as well for corporates.
Well, take us through how it works in credit, the mechanics of it, because I've seen some reports that there may be a delayed response because some companies, and this is both for investment grade but also for high yield or leveraged loans, locked in rates, at a lower rate. That's coming due in the next couple of years, I'm told. A fair amount of money is coming due, and it may be a little difficult to get it refinanced at acceptable levels.
Yeah, so I'd sort of take that into two pieces. So in general, you got a bunch of fixed rate bonds, whether that be investment grade or high yield bonds, that were issued at a different moment in time in the market when the 5-year and the 10-year were significantly lower. Those fixed rate bonds are a real asset right now in the current rate environment. I think on the second end of the spectrum, you've got the loan market, which is a large market, which is all anchored on a base rate plus a spread. And so as that base rates move from 1% to north of 5%, that's hurt businesses a lot. So if you think about sort of corporate balance sheets, an incremental 400 basis points of cost of leverage on their debt stack that is loan related has been pretty painful. The second part of your question is maturities. It actually happens to be that the sort of quote unquote maturity wall is reasonably benign in the next year or so. But as we look forward, if we are living in a kind of longer, or I say higher for longer environment, eventually these companies have to refinance. And eventually that cost of financing is going to be a lot higher. The only other thing I would say is in some of the instances of the high yield market and the loan market, there are folks who have hedged their rate exposure from day zero. That also is obviously a real asset today in today's environment. Not a ton of them, but some of them did.
We've heard a lot of talk by economists about the recession. It's been predicted for a long time now. It seems to be getting put off into prediction. Do you think that the markets, and particularly that spread that we talked about earlier, is that accurately reflecting what you think of as the possibility of recession?
No. I mean, if you look at the median high yield spread over, I guess if you say post-crisis and you sort of take out COVID, there's lots of ways one can slice these numbers. The median high yield spread is north of 500 basis points over. That has been in a 2 to 2.5% GDP environment. Today, we're in the low to mid 400s in a pick your number on GDP. Zero, the estimates are all over the map, but 0 to 1.5%. So definitionally, that's not on par.
Do you position yourself as an investor to be able to buy credit? Are you expecting essentially prices to come down so there are bargains to be had out there? Are you building up dry powder?
I think there's places to add risk right now because I think that overall in the loan market and in the high yield market, even in the securitized credit market, in general, yields are sort of 8 to 10%. So I think in a lower growth environment with a higher rate environment, potentially a sustained higher inflation environment, tightening financial conditions, I actually think in that 8 to 10% zip code, that's a pretty good place to earn yield. However, I do think that I think credit spreads are not indicative of it. I think a lot of that yield is coming from base rates, over 50% of it in most instances. So I think you kind of got to be a little bit careful in terms of where you are. And I suspect you're going to have moments over the next sort of 12 months where there will be some good amount of volatility, and that volatility can come from a variety of places. But I think you'll continue to see some margin degradation, and I think that probably gives you some moments to add more risk as well. But I think short duration, well capitalized businesses are a pretty good spot to live in that zip code of 8 to 10%.